Is there lack of confidence in the Indian mutual fund or Indian AMC space to be able to short the market?
In Indian market, people are not able to, you can say, generate return by going short on market, because as I said already, the last negative year we had was 2015, and that too was -4, and before that 2011 when Nifty was down 25%. So for last 10 years we have not seen a negative year.
Would you also recommend somebody who has a 2-3 year of investment horizon, FD kind of an investor to do?
Anyone who wants to take some equity risk, I think fund is the best product to be investing in. This is the product where you look at again same 3-year, 5-year, 7-year return. Returns are almost in the range of 9 to 11%.
How do you decide that your balance advantage fund currently should be at 70-80% equity or should be at 20-30% equity?
What my model says, सुनने में complex लगेगा, but just to simplify this.
Is there any other risk that somebody should be mindful while they are coming in?
So another risk is,
I would have not asked you this question had we been talking 2 years back. But the question becomes extremely relevant today. Sorry, I know it got a little complicated, but I got excited to ask him that question because... Hi everybody, welcome to a new episode, and in this episode we are going to talk and demystify everything that you would want to know about hybrid mutual funds and SIFs. I'm sure I've received so many queries that people want to know a little more about SIFs. So while I have made a video already on that and I'm hoping that you would have seen that, but today I have got somebody who is probably the right person to ask a lot of difficult questions to in the hybrid mutual fund and the SIF space. So we are going to talk to somebody today who manages 50 to 1000 crore rupees in the hybrid mutual fund and the SIF mutual fund category space. And allow me to welcome Bhavesh. Bhavesh, thank you so much for taking the time out and being a part of this.
thanks for having us, giving us this opportunity. It's our pleasure.
No, the pleasure is completely ours because while we make videos, the idea is very generic around understanding the difference between various hybrid mutual funds or basics of SIFs and all. Most of us and the viewers don't get access to fund managers who actually end up telling us what do you all really do within the fund for us to experience the kind of returns that we experience. So completely our pleasure. Thank you so much for taking the time out. I'm not going to waste a lot of your time. I directly want to jump on to the subject. Now, Bhavesh, I've been generally talking about this on the internet that while you try and invest in mutual funds, there are different styles that different fund managers follow. So there are fund managers who follow momentum style. There are fund managers who follow value investing. There are fund managers who follow growth style of investing.
Yes.
There are some fund managers who say we do top down. There are some say, oh, we do bottom up. There are so many of these different styles that equity fund managers follow. Now, because this show is on hybrid, I want to take your perspective. Is this very similar in the hybrid space? Do AMCs have different style of managing hybrid funds also?
So you can see hybrid is a very vast category. So you have funds like balance advantage fund, and then you have purely execution based products like arbitrage. So again, depending on which kind of product you are looking, style can definitely be different. Sure. Now, as far as balance advantage fund is concerned, which is one of the largest category within the hybrid space, yes, here also fund manager do follow different asset allocation model.
Sure.
So see, right, in equity, there is a stock selection criteria, like you mentioned, growth style, value style, etc. Similarly, in balance advantage fund, there are, you can say, different style at multiple level. First is equity selection. That again, as you mentioned, top down, bottom up, growth, value, etc. is there. But I think the biggest delta in balance advantage fund comes from asset allocation model. And asset allocation model also is totally different. So today, right now, if you will see in industry, couple of the models which are quite popular. One is valuation based asset allocation model. Within that, you have price to earning, price to book, dividend yield, and so many others. And then the other is trend based asset allocation model, which is followed by us. In simple word, one can say it is moving averages or momentum or trend. And right now, a lot of new balance advantage funds are coming, which are trying to use a combination of valuation as well as trend based model. So these are, you can say, 2 or 3 very different model. And definitely, if you look at performance of different funds, the big difference comes purely because of the different asset allocation model they use.
So Bhavesh, because my audience may not know everything that you and I are discussing, I'm just trying to simplify and correct me if I've understood this well.
Sure.
So you're saying there are 7 different categories of hybrid.
Yes.
Within that, there are only 2 categories largely, balance advantage fund, and I'm adding the multi-asset allocation fund.
Yes.
Only 2 categories where actually most of these styles of investing is played. Everything else is very straight,
Or static, you can say.
very
Not
static and
dynamic.
plain vanilla.
Yeah.
Now, when we look at balance advantage or a multi-asset allocation fund, what we are saying is that the money gets invested in equity and fixed income, and probably some part of it gets invested in precious metals and some other alternates. Now, the allocation is not constant. The
Yes.
allocation will keep moving up. So let's say equity sometimes is at 80, sometimes is at 30, and it'll keep moving depending on what your call is.
Yes.
And your call of whether it is 80 or 30 depends on some fund managers use value style or fundamental analysis,
Yes.
and some like you use momentum.
Perfect.
Correct?
Perfect.
Have I got that correct?
Yes. Yes. Perfectly.
Brilliant. Let's try and deep dive a little more.
Sure.
Can you help us understand how do you decide that your balance advantage fund currently should be at 70-80% equity or should be at 20-30% equity?
Sure. So I think before jumping to our model, we will just simplify this, because I think a lot of people still understand valuation, because that is something we have been hearing for last so many years. So valuation based model is quite simple. If today Nifty is trading at a P multiple of 25, 27 or 30, which is higher compared to last 10, 15, 20 years average, automatically you will think that my equity level should be lower.
Sure.
And accordingly, if equity P multiple is say at 12, 15, 16, which is lower than less 10, 15 years average, automatically you will feel that my equity allocation should be higher.
Done.
This is the traditional way of doing asset allocation. Now, the models what we use is totally different, or you can say opposite of this.
Okay.
What my model says, if market is showing strength, increase your equity allocation, and if market is showing weakness, reduce your equity allocation. सुनने में complex लगेगा, but just to simplify this,
Sure.
if a stock is falling down, we never try to make a assumption that bottom is made. We don't say that a stock cannot go below this point,
Okay.
and you should try to buy it at that point of time, because we don't know how much it will fall.
Sure.
And similarly on upside, we have seen, we can take example of one of the stock like DMart. IPO came at 300, became 600. People thought it is expensive. 600 became 1200, 1800, 2400, almost 4000. Sometime it will definitely correct. But if you would have thought that 600 is expensive because of only valuation, you would have missed the entire rally from 600 to 4000. Same thing happens with market. We don't try to make a judgment that 20p multiple is top or 24p multiple is the top. Normally we go with the flow.
Sure.
So in Gujarati, there is a saying, if you would have heard, I'm sure most of your listeners would have heard this saying, Bhav Bhagwan che. We are firm believer of price. We feel that all the good and bad news is reflected in the price. And that's why what we do, our model is very simple. We look at moving averages of the market.
Okay.
So one of the parameter what we look is Nifty 50-day moving average. Quite popular. Most of the people are you can say aware of the term DMA, or in simple word daily moving average. So if Nifty is trading above 50-day average or above 100-day average, my signal will tell me markets are showing strength, because they are trading above their 50-day, 100-day or whatever that number is, above those averages, then you should stay long on market.
Sure.
Like today, if you look at the example, today Nifty is trading almost at say 26,200. It is above its 5-day average, 12-day average, which is my short-term signal, above its 50-day average and 100-day average, which is my medium-term signal, and volatility is at almost, you can say, lowest level we have ever seen. So my long-term signal, which is again volatility based, that also is telling me to go long on market.
Sure.
So normally in balance advantage fund, equity ranges between 30 to 80. Now we have these 3 signals, 5 and 12-day moving average, 50 and 100-day moving average, and 1-year volatility. Now all the 3 signals are telling me to go long on market.
Sure.
And that's why theoretically my exposure is at maximum, which is at 80%.
Because Nifty 50 is trading above 5, 12, 50, 100 moving averages.
And
which
1-year
is why you are
volatility
long,
is low.
and 1-year volatility is extremely low,
Low.
which is why you are long on
Long
market.
on the market.
Right? So your equity exposure is the highest in the market, right?
So theoretically, we are at 80. 80 is the maximum we can go. We are already at 80. Now, as a risk management policy, because of so many geopolitical situations which is going around, you would have heard what happened with Venezuela.
Yeah.
So that's why manually we have reduced 5% equity, and instead of 80, we are running 75% equity.
Okay,
Now look at the difference. From valuation point of view, markets are still expensive. And that's why those who follow pure valuation based
They are
asset
still low on
allocation,
equity.
they are running right now anywhere between 40 to 50% equity.
And you are
So,
at
and we are
75.
almost at 75. And that is where normally, as I said, it directly gets reflected in performance also. If market keeps on going higher, a trend based model will always outperform. And if markets remain range bound or choppy, a valuation based model normally tends to outperform.
But what I also understand is that y'all are probably the only ones who follow in the BAF DAF category, probably the only one who follow momentum based.
Yes, so 100% momentum, we are the only one. But as I said, right now, a lot of new coming AMCs or newly launched BAF,
They use a
they are using
combination.
a combination of trend plus valuation. But it is like, if you follow cricket, in cricketing terminology, you can either be Rahul Dravid or you can be Virendra Sehwag. You
be a
cannot say I want to be combination of both,
combination of
and then you will not be moving
Anywhere.
either side.
Anyway.
So that's why either you follow pure valuation based model, which will help you in a range bound
Yeah.
market, or you follow a trend based model, which will help you in trending market. A combination model, your equity allocation will always be at center, which is roughly 50 to 60%.
Understood.
Neither you will go to 30, neither you will go to 80, because today when trend is good, valuations are bad. During COVID, when valuations were very good, trend was very bad.
Correct.
So you will never get, rarely you will get a situation where both are moving together.
Now I want to slightly deep dive a little more on what you've just discussed with me.
Yeah.
Let's say today your model is showing 75, 80, but you've taken the 5%
Risk management fall.
leverage for risk management. Now let's say, for example, at some point in time you'll start falling below 150, so you will reduce, and then you'll fall below 5 and 12, you will reduce further. Do you actually sell equity? The reason why I'm asking you this question is because if you end up selling equity, then at higher AUMs, is it really possible for you to be able to do this?
I think very important question, and I'm sure a lot of people are not aware. If we keep on selling and buying equity depending on the change in our allocation, first taxation will go for a toss because my equity will go down below 65, and then I will not be there.
Exactly.
Today, as I said, a lot of fund are at 40-50% equity. If they sell equity, their taxation will not be equity taxation. Second, cost. Impact cost as well as brokerage and STT.
Correct.
Selling and buying equity, a round trip cost even to a mutual fund is anywhere between 35 to 36 basis point. Whereas buying and selling derivative, the cost is just 4 basis point.
Oh,
so
wow.
what we do is, and again impact cost obviously because equity will be much more illiquid compared to the derivative, that impact cost will be over and above
Absolutely.
the trading cost. So normally what most of the funds do, they use derivative to change their allocation.
Okay.
Now within derivative, someone will be using stock future to hedge their portfolio or in a way convert their position into an arbitrage position.
Sure.
Or someone like Edelweiss where we use index future and index put option to change our allocation. Different, you can say, instruments
So you
can
buy
be
a
used.
put.
We will buy put, we will sell index future,
Okay.
we can sell call option of stocks. We have multiple instruments,
Sure.
but broadly all of them are derivative.
I think, Bhavesh, that's a very interesting perspective because I'm sure a lot of people, when you said that you sell equity and you buy equity, would have generally thought that you are actually buying equity and selling equity. And I think a very interesting perspective on the cost and the impact that you did mention
Yes.
makes so much of sense for you to actually use derivatives and not really buy and sell equity.
Yeah.
So one part is of course equity, right? But the other part is debt. So correct me if I understand this well. When you increase and decrease your equity using derivatives, but your fixed income is still constant throughout the period. Do I understand that well?
Yes. So fixed income, as in like whatever debt paper we bought remains constant, but allocation to debt changes because in a way when we use derivative,
Correct.
we are actually converting our position into arbitrage.
Correct.
So that also will keep on giving us returns like what an arbitrage fund delivers.
Correct.
So that also adds to fixed income return.
Very interesting. And what is your strategy on the debt part?
So debt, I think because in hybrid anyways we have complex things like equity, hedging model, asset allocation and so on and so forth. So we try to keep our debt very simple. We run plain accrual based strategy only into AAA rated assets. And a part of that goes into either in our liquid fund or some T-bill, which we place with exchange for derivative margin. For all the options trading and future tradings, what we do, we place our liquid fund and some T-bills as a collateral for trading derivatives.
So very interesting strategy. If I invest 100 rupees in your fund, you will typically have 20, 30, whatever that is in constant fixed income product.
Yes.
And then you will try and increase and decrease your equity allocation using derivatives depending on the model that you spoke of.
Perfect.
Very interesting. Now, what I understand is that I will get a client of mine to invest in a hybrid product like, let's say, a balance advantage fund, because this client is not somebody who's very aggressive and wants to take equity allocation on the 100% investment. And hence, the downside protection is extremely important while you are doing hybrid investments,
Yes.
right? Help us understand, how do you or what do you rather do, or how do you strategize to make sure that the downside to the investor is lower, but still, or yet we are not compromising on the returns on the higher side?
Sure. I think we can take a perfect example of COVID fall,
Please.
because that is, if you recollect memories of last almost 10 years now, other than that 3 months of COVID, there is no actual fall which has happened in market. In fact, we have not seen a negative year in last 10 years. COVID also, for all practical purpose, was a positive year.
Correct.
But that quarter was very painful. Now, if you will see in that period, somewhere around middle of Jan, Nifty hit lifetime high of 12,400. And then within next couple of months, because of COVID and lockdown and on so forth, Nifty corrected all the way from 12,400 to 7,600. A 38% fall in just 2 months. Now, if we would have this conversation on, say, 14th of Jan 2020, markets are at lifetime high. Because markets are at lifetime high, trend is super positive.
Correct. You would be
Edelweiss
70-80%
75% net equity.
Correct.
And at lifetime high, valuation will always be expensive. Like today, fund, I will not name the fund, but the largest fund using valuation as a model was
would be the
sitting
lowest on
at
equity.
35-37% net
Correct.
equity. Now, if I ask you the question that on 14th of Jan, I am sitting at 75% equity, fund B is sitting at 35% equity, and in next 2 months, Nifty will be down 40%. What would your assumption be? Who will correct more?
You will
Edelweiss
correct.
or the other
You
fund?
will correct more.
And now when you flip and you look at the actual number, in that 38% fall from 12,400 to 7,600, Edelweiss Balance Advantage Fund, which started at 75% net equity, we ended with fall of 14%. Whereas a competition fund, which was sitting at 37% equity, which normally people term as a conservative balance advantage fund, was down almost double of us, 27%.
How is it possible?
And now, yes, so that is where the entire asset allocation model comes into picture. Now, as I told you, our model at 12,400 when Nifty is at lifetime high. If today's closing at lifetime high, it is definitely above all the moving averages.
Correct.
But as soon as Nifty corrected from 12,400 to 11,800, first 5% fall, Nifty closed below its 5-day average and 12-day average. My allocation from 80 came down to 63, 17% each signal. Then at 11,300, it closed below 50 and 100-day average. And at 11,000, volatility spiked. After a 10% fall, volatility spiked. And as a result, from 12,400 to 11,000, my equity allocation came down to almost 35% from highest to lowest. And from 11,000...
Sorry, I'm going to ask you to take a pause here and explain what you just said, because I'm not sure if they would have understood this.
Sure.
And correct me if I've understood this well.
Perfect.
There are 3 models, or there are 3 signals that you use. 5 and 12-day moving average, which has 17% weight.
Yes.
50 and 100-day moving average, which has 17% weight. And volatility has 17%
Yes.
weight.
And
so when the markets fell from 12,400 to 11,800,
first signal went off.
First signal went off because the market closed below 5 and
12-day average. Perfect.
So you reduced your equity allocation by 17%.
Yes, by selling derivative,
Correct.
not by selling equity.
By selling derivatives. Then when the markets fell further and it came below the 50, 100-day, you reduced it even 47. Lower by 17% to 47.
Yes.
And because the volatility spiked, you reduced it even by 17%.
Yes.
So between 12,400 and 11,000, your portfolio actually came down from 75, 80 to
almost 35.
35%. Okay.
Yes. And now, so this is how from 11,000 to 7,600, Nifty never closed above 50, 100 DMA, volatility never came down, 512 DMA was always down. And as a result, we were able to protect that entire fall from 11,000 to 7,600. Now, just think from a valuation based point of view, at 12,400 valuations were very expensive. When market corrected at 11,500, slightly better.
Yeah, it didn't become anything interesting.
And at 10,500, after a 20% fall, valuation became reasonable. And you thought that at 10,000, we are already down 2,400
Correct.
points. Valuations are back to historical averages. People added in equity. So those funds were sitting at 35, 37% equity.
50, 60.
They have gone to 65, 70.
Okay.
And at 10,000, where you thought that market is almost at bottom, Nifty corrected by another 25%. And that is where the entire game changed. In first 10% fall, they were outperforming us. But in the substantial 25% fall from 10,000 to 7,600, we were able to protect that entire downside.
So at 10,000, they added equity because
valuation became attractive.
Because valuation became attractive. And you did not add equity because you were still...
Trend was continuously weak.
You were still below 5, 12,
50, 100 and volatility was higher.
Okay, very interesting.
And that's why in that subsequent fall, so March 2020, in 1 month, Nifty was down 23%, where we were down only 9%. So roughly, because we can never go below 30% net equity, at 35% equity against 23% fall, we were down 9. But all those valuation-based funds were down anywhere between 15 to 20%. And that is where we were able to protect your downside, even though we started at much higher equity allocation.
Very interesting.
So that is how we protect your downside. And now the opposite side of also is to be very important.
Correct.
On 23rd March, Nifty was at 7,600. On 31st March, we were still into that COVID dilemma and all that work from home and all. Nifty from 7,600 became 8,600 just in 7 days. So again, I will not say that I captured the perfect bottom at 7,600 and arise.
But I think it
but as soon as Nifty from 7,600 moved to 8,600, it closed above 5 and 12. And my exposure also started going up in line with valuation-based fund.
Okay.
Now the difference is they went long at 10,000. I went long at 8,600. None of us captured 7,600 or 12,400. But the difference is we were able to protect that extra 14-15% because 10,000 versus 8,600 was my entry level. And that's why when you look at full calendar year 2020, it was first 3 year a big bear market and the next 9 months was a raging bull market. In the overall 2020 calendar year, Nifty was up 15%. In a balanced advantage fund where we never take our equity above 80, our return in that year was 23%.
Oh.
So 15 versus 23 versus the largest valuation-based fund delivered only 11% return. So look at the gap, 11 versus 23 in just one single year.
But also help me understand, I'm sure your strategy will not work in all kind of markets, right?
Yes.
And similarly with them, their strategy is not going to work in all kind of markets. So first, which strategy amongst the two, and let's not complicate including the newer guys.
Yes.
Which strategy will work in which kind of market? And if let's say I have 100 rupees with a 5-year view, as an investor, what should I do?
Yes. So I think for that, the basic of the both of the styles is to be understood. First, as the name suggests, my strategy is trend-based asset allocation model.
Correct.
That means it will work only in trending market. Now, what is trending market? All markets where Nifty is giving you double-digit return, either positive, so it is bullish trending, or negative, which is bearish trending. In a range-bound market, a valuation-based model will always outperform us. So you look at last 18 months, markets more or less have remained flat.
And you would have not
and
done
that is where we would have underperformed and a valuation-based fund would have outperformed because Nifty multiple time from 26,000 to 23,000, back to 26,000, again back to 24,000, back to 26,000. So they will be buying at 23, 24, selling at 26,
Correct.
again buying at 23. So market is not going anywhere, but they are making money because of multiple entry and exit.
Correct.
Whereas in our case, we are getting whipsawed on both the side. So this is the period where we will underperform. Now again, which model? None of us is correct 100% of the time. Now if you have to select one, ideally what we say, don't select one, diversify in two, take one value, take one trend.
Makes sense.
In value, you have 15 options to select from. In trend, you have only one option to select, that is Edelweiss BAF. But just for, you can say, argument's sake, if we have to select one out of the two, which one is better, then you take data for last 20 years. 15 years Nifty has given you double-digit return, either positive or negative like 2008 and 2011.
So there is a trend.
So 75% of the time, Indian markets have remained trending. And only 25% of the time it has given you single-digit return, which is a range-bound market. So probability-wise, probability of me getting it right is almost 3 times higher compared to a valuation-based fund. But still what we suggest, normally go for diversification. And in that also you have an option.
I'll tell you what the problem is. The problem is that people will see the last 3 years of return where you've done well and come in.
Yes.
At the cycle where you're not supposed to do well in the next 2-3 years.
So that is always that is always there. And that's why we say diversify between, you can say, two different style rather than you can say selecting one over other.
No, that 100% definitely makes a lot of sense is because you always want to be invested in a fund where if you're investing in hybrid, you want to protect the downside.
Yes.
You don't want to invest in a fund where you thought that if I invest, my downside will get protected, but that does not turn out to be true when the event comes up. So extremely important for a hybrid fund to be able to protect the downside without compromising the upside if at all the market has that opportunity to give over a period of time.
And that's why what we always say that In balanced advantage fund, if you stay invested for 3 to 5 years, you will get equity-like return with much lower volatility and drawdown. If that is your objective, then some year X balanced advantage fund will do better, someone Y will do better, but over a 3 to 5 year, all of us will do better than your normal equity product.
So that brings me to the next question, which is very interesting. So I was looking at the last 3 year, 5 year, 7 year of data, and I'm taking only 7 years because recategorization happened in 2018.
17,
So makes no sense going below that, right? So I was looking at the 3 year, 5 year, 7 year data, and I realized that with much lower risk, the aggressive hybrid has given the same return as the large cap equity fund. So if I can quote the data, standard deviation of aggressive hybrid was 10 units and average category was 13 in case of large cap equity. And the returns were exactly the same. So I'm taking 3 units of lower risk by investing in aggressive hybrid, and my return is exactly same that of the large cap equity. Why will I do large cap equity?
So I think very interesting data, and I think we have similar data set for balanced advantage fund where volatility is even further lower. So if large cap has standard deviation of around 13, balanced advantage fund will have standard deviation of around 7 to 8, aggressive hybrid fund at 9 to 10. And return wise, balanced advantage fund will be matching Nifty, and your aggressive hybrid fund would be managing large cap, whatever 1 or 2% alpha you get over there. And overall, if the client intention is to get Nifty or large cap kind return, then why to take that extra risk, extra volatility, when with much lower drawdown, much lower volatility, you are able to get similar return. And see, Nifty, today you look at return, it looks at 13% CAGR or 12% CAGR. But in between, you have to keep in mind that there was the COVID fall, where markets were down 40%. To get that 12% CAGR, one have to survive that 40% drawdown, which normally you would have seen a lot of investors are not able to digest.
Correct.
And that is where balanced advantage fund and aggressive hybrid fund even become more important, because to enjoy that 12% CAGR, you have to stay invested for 7 years. And that is where, when everything is down 40%, if the BAF is down 14, the client will have that confidence and comfort to stay invested for longer period of time. Same thing with aggressive hybrid fund.
So brilliant. What I hear from you is balanced advantage fund and aggressive hybrid fund is a great replacement to your large cap equity fund, because ultimately it will protect your downside much more than your large cap, and at the same time you don't compromise on the returns. Very interesting. But I have a counter question.
And no biasness from my end, because I am fund manager for Edelweiss Large Cap Fund, Edelweiss Balanced Advantage Fund, as well as Edelweiss Aggressive Hybrid Fund and Edelweiss Nifty ETF. So I am doing active, passive and hybrid, all three. So no biasness. I can give you an honest opinion.
No, don't worry. I will pull you if at all I think you are going biased. But jokes apart, what I now want to understand is that I see one problem with the balanced advantage category, and I would have not asked you this question had we been talking 2 years back. But the question becomes extremely relevant today is because gold and silver has moved up so much in the last 12-18 months that a multi-asset allocation fund today looks extremely interesting. So I will quote some data that I was looking at. Again, 3 year, 5 year, 7 year data. The multi-asset category return has generated 5% CAGR over average BAF. 5% over 3 year, 5 year, 7 year.
Yes.
With, of course, the same, but technically slightly lower risk than BAF. Then now the question that comes to my mind is, I understand that gold and silver has actually gone up over the last 12-18 months, and which is what is getting reflected in the multi-asset category. But again, if I have to ask you the same question, that if I have 100 rupees, do I diversify across 2 BAFs, one with momentum, one with value, or now should I consider multi-asset also?
See, I think gold and silver had a dream run over last 12 to 18 months. And looking at the geopolitical situation, we cannot even say that we are already at the top.
Correct.
Because we have seen one more event on weekend, and today again gold and silver are up anywhere between 2 to 7%. And we expect such kind of event will increase further as geopolitical tension, you can say, increases. So in that context, definitely one should have some allocation to gold and silver. If you ask me, after 18 months of consolidation in equity and almost 150% return in gold and silver, if I have to take a risk reward call right now, I will prefer equity over gold and silver.
Agreed.
And because you are investing with a 3 year, 5 year mindset, considering either it is BAF or a MAF, you are investing with a 3 year horizon. I think over next 3 years, probability of equity outperforming gold and silver is significantly higher. And in that context, a BAF outperforming MAF is also equally higher.
Also, let's look at a slightly a separate situation. Let's say I'm trying to build a pretty long-term portfolio, which is very strategic and core. I'm not going to move that too much here and there. So can I say that I can use an aggressive hybrid / BAF for large cap?
Yes.
I can do mid cap, small cap, and I can do a MAF for the gold and silver allocation that I want.
I will still say that for gold and silver, you can directly use gold and silver ETF, or you can say a gold and silver fund of fund kind of things, rather than using MAF incrementally, because I think aggressive hybrid fund along with balanced advantage fund will take care of your equity allocation.
Sure.
You don't want a dynamic fund at this point of time, because see, today, if you just look at the data again, if you go back 18 months, how many multi-asset funds were overweight on gold and silver versus how many of them today are overweight on gold and silver? Part of that is because of mark to market, and part of that is because of FOMO. And that's why allocation, which should have been higher to gold and silver, say 24 months ago, is now at very high.
Sure.
And then that is where normally things will turn. And then incremental returns in equity will be much, much better compared to gold and silver. And then people will do that course correction over next 24 months and 36 months. So better have some allocation to gold and silver in the form of ETF, or you can say fund of fund, and give higher allocation to aggressive hybrid fund in today's environment.
Very interesting. Would you also recommend somebody who has a 2-3 year of investment horizon, FD kind of an investor, to do equity savings?
Definitely, I think, amongst all the hybrid fund, other than arbitrage, which is purely a debt fund, anyone who wants to take some equity risk, I think equity saving fund is the best product to be investing in. This is the product where you look at, again, same 3 year, 5 year, 7 year return. Returns are almost in the range of 9 to 11%.
Correct.
Much better than what your traditional FD investment would have given you, with very little volatility, very little drawdown. If you look at average return, it is around 10. Or if you look at rolling 3 year, lowest return is around 7-8.
Yeah.
Which is still better than most of your fixed
Plus
income.
taxation.
And plus taxation advantage is always there. And I think in today's environment, again, where
if you could explain the taxation advantage, please.
So if you invest in FD or any other fixed income instrument, you are paying full tax.
Yeah.
Whereas in equity saving fund, because it is finally an equity product with just 25% naked equity, again that range is 20 to 40 for others, but with just 25% equity, you get equity taxation because you have 40% in arbitrage.
Correct.
So your gross equity is more than 65 because of a combination of long only equity and arbitrage. So taxation wise, you get equity
so in
taxation.
Equity savings, if somebody is staying invested for more than a year, they will pay only
12.5% and education cession surcharge.
Versus in the FD,
30.
they will pay slab rate.
30 plus whatever that surcharge and education surcharge.
Very interesting, right? So hybrid, what I understand, is for any and everybody, right?
Yes.
Somebody who's looking at an FD replacement has equity savings. Somebody who's probably looking at a 3 year, 5 year investment horizon, probably does not want to take complete equity risk. Large cap kind of investor has.
So how we look at hybrid is,
Please.
Hybrid is the product for a fresher who is investing into the mutual fund for the first time. Like a lot of people now are moving from FDs and fixed income to equity.
Can you label a product to each of these examples?
Sure. So I think if you look at all the hybrid fund, we start with arbitrage fund, and like Edelweiss have a multi-asset arbitrage fund also, where we have 0% naked equity. So this is the product for an investor who is looking at post-tax better return compared to liquid fund or an FD.
Sure.
So normally return range is 5 to 7%. You will never get a negative quarter. You may get 1 month, 15 days of negative return, but never get a negative quarter. So that's why we say you should invest minimum for 3 months so that you don't end up getting that negative 1 month return. And you are happy with 5-7% as a pure debt replacement. Then those who want slightly better return, as I said, people who go into either a tax-free bond or some corporate FDs to increase their return, for those set of investor, equity saving fund is the product, where instead of 0% equity, you take 25% equity, but your returns are almost 9 to 10%.
Sure.
So for 25% equity, you get 2% extra return.
Plus tax advantage.
Plus tax. So tax advantage is all the funds are equity taxation. Then you move to balance advantage fund, where average equity is around 50 to 55. 30 to 80 is the broad range. Average is around 50-55. So again, for extra 25% equity, you get 2% extra return. So balance advantage fund will deliver 9 to 11% return. But you have to come for minimum 3 years, because balance advantage fund has sizable portion in equity. So when your 1 year and 2 year returns can go negative. But 3 year plus, normally you will get decent double digit kind of return. Then again, aggressive hybrid fund is opposite of equity saving. Equity saving was 25% equity, 75% arbitrage and debt. Aggressive hybrid is 75% equity and 25% debt. There, someone wants return of 11 to 14%. I think they can look at aggressive hybrid fund, similar to what a large cap fund is delivering you, but with much lower volatility compared to a large cap. So 0% equity, 25% equity, 50% equity, 75% equity, and then for 100% equity, you have all your equity product. Now, this is, you can say, on the risk parameter, return parameter, and accordingly duration also. Arbitrage is minimum 3 months, equity saving is anywhere between 1 year to 3 year, BAF is anywhere between 3 year to 5 year, aggressive hybrid is 5 year and above. So this is how normally we look at all these products.
Sure.
Now, the interesting part is, today, this is a product, all these products put together, even a fresher can invest and even a retired person can invest. Someone who is very conservative can also invest, and someone who is very aggressive can also invest. Because see, normally what is the sign of an aggressive person? He is always fully deployed. So if there is a COVID like a fall, he don't have extra money to average it out at a lower level. So if he would have some allocation to BAF or aggressive hybrid fund, in that 40% fall, his BAF would be down only 14%. So he can book losses of 14% and invest in mid cap and small cap at 40-50% lower levels. So even for an aggressive investor, because see, he don't want to compromise on his upside. So by investing in BAF and aggressive hybrid fund, you are not compromising on your upside. Like in large cap, both aggressive hybrid fund and large cap gives you similar return. But on downside, it helps you to average it out at a lower level. So even for an aggressive investor, this is a good product to invest in.
Very interesting. Very interesting. Let me draw your attention to something interesting that has happened to the market in terms of product. SIF.
Yes.
So first, of course, I'm not sure if the viewers know about what SIF is. So while I start asking you technical questions around what you do in your SIF fund, can you first help us understand what is SIF? What's the logic of SIF? Why is it introduced? What problem is it really trying to solve? What is this?
Sure. I think definitely over next 3 to 5 years, the entire discussion as of now, what we had was on MF, but maybe next 3 to 5 years, people will have all the discussion only on SIF. That is how interesting a category like SIF is. Now, specialized investment fund, in simple layman term, if we have to explain it to anyone, it is nothing but AIF with mutual fund taxation. That is the one-line definition. But to simplify it further, first, why it was introduced? See, mutual fund are there for last 30 years, have done a great work. We have more than 75-80 lakh crore of assets and a decent track record without any big goof up over last many years. But more or less, it was becoming a commoditized product.
Correct.
Because of, you can say, as we talk about recategorization, after that, leeway to fund manager was very limited. If it is a large cap fund, 80% have to be in that top 100 stock, mid cap 65% in that 150 stocks. So a fund manager had very limited headroom to make changes or generate alpha.
Sure.
Second, by design, all products were long only, and as a fund manager, I was not able to express my negative view on market.
Can you please explain that?
So like in mutual fund, even if I am negative on market, at best what I can do, I can take some cash call.
Correct.
That's it. And cash call also will not generate return for me in a falling market. It will protect my losses, but it will not generate income for me. If I had an option to go short, not only on market, there are few sectors, there are few stocks, which even in the best of the bull market are negative.
Correct.
So that view fund manager cannot express it mutual fund, because by design, all are long only funds. So now
in mutual funds, you are saying that you as a fund manager, in spite of believing that the markets will go down, cannot short the market and benefit from that.
Yes. So at best we can, like for example, there are few sectors or stocks where even markets are not doing anything, but we feel that this stock is extremely overvalued. It will correct. So in mutual fund, at best you can take a cash call.
Correct.
You will not buy that stock. But in SIF, I can actually go short on that stock. And if my view go right, I will make profit. I will not only protect my loss, but I will generate returns even in a falling market. So that is something which is very important. Third, and I think the biggest problem was, you would have heard multiple, you can say, data from SEBI, study from SEBI, where almost 90% of retail and HNI investors are burning their hand in derivative trading.
Correct.
And the losses for last year was more than 1 lakh crore. Now, SEBI did multiple steps by increasing lot size, you can say, reducing number of weekly expiry, taking action against some of the hedge funds and all. But still, no benefit.
Yeah.
The number keeps on increasing, the loss keep on increasing. So I think that was another way of SEBI to at least move a part of those investors into SIF, which is very heavy on derivative trading, but at least through a professional approach.
So can I say, if I have to sum this up in one line, can I say that SIF is a mutual fund in which the fund manager will have the leeway to even short the market to make
Yes.
money, and SEBI's directive in sorts is that instead of you doing FNO and losing money, give it to a professional who can do it in a much better way.
better way. Perfect, perfect. And in that context, though it is, as I said, it is a mini AIF. Why it is a mini AIF? Because in AIF you can take leverage.
Yeah.
Now the biggest worry with everyone doing derivative trading is leverage. SEBI has categorically denied leverage to mutual fund, and SIF is nothing but another scheme of mutual fund.
Correct.
So we cannot take leverage. So that risk is, you can say, taken care of by the design of the product itself. Second, in SIF there is no restriction on shorting the market. Here in MF we were not allowed to short at all. In SIF they have allowed it, but only up to 25% of your AUM.
Correct.
So at least, as I said, from flexibility part of it, like in MF, there is restriction, large cap, mid cap, small cap. There is no such restriction over there. Plus, use of derivatives is freely allowed. And see, normally there is a big myth in the market. People think that derivative means high risk, high return. In fact, today you will see the most conservative equity product is arbitrage.
Yeah.
100% on derivative. Equity saving fund, almost 70% on derivative, and they are the most, you can say, consistent and low volatile product. So derivative, if used properly, can actually enhance your return and reduce your risk. So that is why use of derivative is not necessarily high risk, high return. We are not going to construct a portfolio which will give you 50 and 100% CAGR, but we will give you products, we will design products which will give you returns which are much better compared to your traditional mutual fund schemes and with much lower risk and drawdown.
I have a counter to that before I deep dive into what y'all are doing currently. So I was looking at some data of AIFs, specifically category 3, which are the hedge fund sorts. Like you said, they have 200%
Leverage
and all of that. But 83-84% of the funds that I looked at the fund universe, none of these guys are shorting. They are category 3 product. They are allowed to short the market, but they are all long only fund.
Yes.
Is there lack of confidence in the Indian mutual fund or Indian AMC space to be able to short the market? And a continuing question is, if that's the case, then what's the point of being able to short the market?
Yes, I think, see, again, as I said, the misconception in Indian market, people are not able to, you can say, generate return by going short on market, because as I said already, the last negative year we had was 2015, and that too was -4, and before that 2011 when Nifty was down 25%. So for last 10 years we have not seen a negative year. So anyways, if someone was shorting, he would have not survived for 10 years, and that's why when you look at latest data, you don't find anyone shorting the market. Now see, use of derivative and going short on market not necessarily means that you have to go short and make profit. You can use derivative in a very good manner without taking any directional view, like selling call options, selling put options, straddle, stangle, put call parity.
Sure.
So many conservative derivative strategies which can give you like an FD plus 3%, FD plus 5% kind of return without any equity directional risk or without any equity volatility. So shorting have to be looked upon in a different way. Shorting not necessarily means that I am short directionally.
Sure.
I can be short on call option and put option. And if stocks remains range bound, I will eat premium from both the legs. So there can be multiple ways where you can use this derivative, particularly the short side of it.
Is that the reason why out of the 6 AMCs who've launched the SIFs, 5 of them have launched hybrid category SIFs, and there is only one who's gone long short on equity, and not everybody? Because I originally thought that the way it was marketed, a lot of long short funds will come out, right? But out of 6, 5 of them, including yours, you all have come out with a hybrid.
Yeah. So again, see, all the 7 categories which are allowed by the regulator under the SIF platform, all by name will be long short fund. Whether it is equity long short, hybrid long short, debt long short, any product, all will be named long short fund, and that's why they will come under a separate brand name. Like in our case, it is not Edelweiss SIF, it is Altiva SIF, and all long short fund will be part of Altiva. Now the reason why everyone is going ahead and launching a hybrid long short fund, because out of all the 7 categories.
First, can you please explain the hybrid long short?
Yes. So hybrid long short category is very simple. The regulation says you should be always minimum 25% in equity, 25% in debt. Now, whether that equity is large cap, mid cap, small cap, arbitrage, hedge, AMC's choice, fund manager's choice. And again, debt is AA, AAA, long term, short term, long or short, again AMC choice. So 25% equity, 25% debt. It can be long, it can be short, totally AMC to AMC choice.
Sure.
Look at the flexibility part of it. I just have to have 25% in equity and 25% into debt. So it is the easiest of the 7. And for us, the reason why we and why I think most of us are launching hybrid long short fund, because that is the biggest gap available in market today. Look at all the product. If I'm an aggressive equity investor, I have AIF, I have PMS, I have mid cap fund, small cap fund, I have some micro cap index, so many things to invest.
Sure.
If I'm conservative equity investor, I have the entire hybrid space, balance advantage fund, multi-asset, aggressive hybrid, so many other product. What is the option available if I am a pure fixed income investor? All my fixed income products have gone for a toss because of taxation.
Yeah.
No flows over last, you can say, couple of years. Second, after this 125 basis point rate cut, my accrual also have come down. So like earlier, arbitrage funds and fixed income funds was giving me 7.5% return. Now after this 125 basis point rate cut, that number also have come down.
Correct.
So today it is very difficult for a pure fixed income investor to make post-tax 5% plus return. If you go to one category higher like arbitrage fund, income plus arbitrage, multi-asset arbitrage, you can get 1% higher return.
Sure.
So instead of 5, you will get 6. But
Post-tax.
what about that? Post-tax, I am not able to make more than 6% return. That is where if I use hybrid long short as a category, where I am slightly riskier than arbitrage because I am not 100% hedge,
Sure.
but I am very much conservative compared to the safest equity product, which is equity saving fund. Because I don't have a core equity portfolio.
Sure.
I have a tactical long portfolio and tactical short portfolio. So without taking any 25%, 50%, 70% equity exposure, if I am able to deliver arbitrage plus 3%, 4% kind of return, there is a huge demand or huge vacancy for this kind of product on MF platform. Today, more than 3 lakh crore is sitting in arbitrage fund, generating less than 6% post-tax return. And then you have more than 3 lakh sitting in balance advantage fund with 7-8%, 9% standard deviation, generating 10 to 12% return. If I bring a product where by use of derivative, like as I said, straddle, stangle, covered call, and so many conservative derivative strategies, if I'm able to deliver 10% return with say 3% standard deviation, a 3-year debt product like short-term funds have standard deviation of 1.5, 2. If I launch a product on SIF, like what we have launched with a standard deviation of 2 to 3%, if I'm able to deliver 10% return, it will not only compete with all my fixed income solution, it is a replacement to my arbitrage, my equity saving fund, my balance advantage fund, and we will not be surprised even to some of your equity product where you are getting 10 to 11% return.
Correct me if I can summarize what you are saying. In an arbitrage fund, your expectation is 6%, but your standard deviation is 0.5.
Yes.
In a debt product, a short-term debt product, your post-tax return is 5%, right? But your standard deviation is 1.5, 2.
Yes.
In an equity savings, in a SIF that we are talking about hybrid right now, you will do 10% pre-tax, which probably will be 8.5 post-tax. But your standard deviation is 3.5, 4.
Yes.
So you're saying your standard deviation is very, very similar to an equity savings.
Much lower than that, in fact.
Right? But you are delivering equity savings kind of return.
Yes.
So this is a great fixed income replacement product. And that is the opportunity everybody in the industry is trying to tap into.
Because that is the biggest gap available right now. See, as you said, there are products like equity long short and X top 100 long short, which everyone thought that intuitively that is the product one should go ahead.
Yeah.
But after 18 months of zero return in equity, today I don't want a product where I can go short on market. If this product would have launched when Nifty is at, you can have a euphoric bull market.
Sure.
That is where I want to have a short product. Today, as I said, move to equity from balance advantage fund, move to aggressive hybrid fund, because you should have higher equity allocation after this 18 months of correction. So at one place, I am telling you that launch product or invest in product which have higher equity allocation. Then at this point of time, launching an X top 100 long short or an equity long short will not help you, because short will be beneficial only in a raging bull market.
Sure.
Right now, we are just entering into, you can say, from a consolidation phase, we are just entering into that small uptick where we are closing above lifetime high. We should have a decent run up in next, say, 12 to 18 months. And that is where I think one should start looking at aggressive short product. So we have launched hybrid long short fund. The second product definitely from our end will be either a equity X top 100 long short fund or a multi-asset allocator long short fund.
Okay.
But both of them we will launch at a time where we feel that now equity market have seen a decent run up. Now asset allocation divergence, or you can say taking short position in selective equity names, will be useful at that point of time.
But I'll tell you, there is some complexity here from a viewer standpoint.
Yeah.
Because you might say that this category is constant, right? Everybody, I told you out of 5 people have launched a hybrid long short, right? But not everybody's long short is the same. I was just reading some data. Your long short is more arbitrage plus 2-3%. There is somebody else's long short that I was looking at was still under the hybrid category, but it was more like an equity product.
Yes.
So
that is where I said over next 3 to 5 years, the maximum debate in the markets would be on SIF. Because one, taxation advantage like mutual fund, and second, flexibility like an AIF. So today, as we discussed, 4 hybrid category: arbitrage fund, equity saving fund, balance advantage fund, and aggressive hybrid fund.
Sure.
2 SIF are yet to be launched, 2 hybrid long short, because they have filed for the, you can say, approval, but yet to be launched. 4 are already there in market. Our strategy is like an arbitrage plus strategy.
Correct.
So within mutual fund, you have an arbitrage fund. My strategy is arbitrage plus.
Sure.
You have an equity saving fund where you have some naked equity element.
Yeah.
So one of the competitor, which is the largest SIF today, have launched an equity saving fund plus category.
Sure.
One more, which was the first one to launch, has actually launched an balance advantage fund plus version of SIF. And the fourth, which is the latest to launch, has actually launched an aggressive hybrid fund variant where they give redemption only once in a month.
And all of these come under the
One
hybrid
name,
SIF,
hybrid long short fund.
long short
And that's
category.
why I said the flexibility part
Very
of it is
interesting.
so huge
Very interesting.
that you cannot compare, like today you compare 10 large cap fund, 10
You can't,
arbitrage fund.
you can't.
You
They are so
cannot do
different
this
from
over
each
here.
other.
4 are actually 4 different hybrid category. So you have to evaluate each and every product separately. Don't just look at NAV and don't just look at asset allocation. Their day-to-day, you can say, working will be totally different from each other. So again, just to put in numbers, if I look at say just 2.5 months, very small period, but just to, you can say, have this discussion. In last 2.5 months, our returns are roughly 3%, but our standard deviation is less than 2, and our portfolio beta is 0.07.
Oh wow.
Now, within the same period, some fund which was launched exactly on the same date where we launched, they have a standard deviation of almost 3. Again, much lower compared to normal product, but compared to us 50% higher, and have a portfolio beta of 0.33. So it is like comparing an arbitrage fund with an equity saving fund. Returns, we are delivered 3% return. The other fund have delivered around 2.5% return. So return wise, we are almost, you can say, 50 basis point higher. But look at the risk part of it. Portfolio beta of 0.07 versus 0.33. Again, 2.5 months is a very small period to comparison. But that is how data will, you can say, over a period of time, it will shape up. That same product, but one with portfolio beta of 0.07 and other at 0.33.
Because they are completely different product under the same head.
So it is like arbitrage fund and equity saving fund.
Completely different products.
So in bull market, you will find equity saving fund is doing better because they have 25% naked equity. And in a bear market, we will do better because we don't have actually any naked equity.
Correct. So I think that's a very interesting point that you've raised, that people should not just look at the category, compare the returns of the fund and say, I will go for this fund.
Yes.
Because within the same category, there are 4 different animals altogether.
Yes, yes.
Okay. Now, because you named your, you pointed out your returns and standard deviation and all, help us understand what have you done in the fund in the last 2.5 months? So what kind of strategy, what did you buy, sell? And what's the logic?
So, as I said, our strategy is an arbitrage plus strategy.
Sure.
So, we are, you can say, placing ourselves somewhere in between pure arbitrage fund and pure equity saving fund. So, arbitrage is 0% equity. Equity saving is minimum 25% naked equity. We are somewhere in between there because we don't have 100% hedge position, but at the same time, we don't have a core equity portfolio. So, my strategy is divided into 4 buckets. First is arbitrage. So we buy Reliance, we sell Reliance future and try to capture that gap between cash and future. Second, which is almost 60% of my portfolio, is fixed income. We have AA rated paper, AAA rated paper, and less than 90-day T-bill, which we place with exchange for derivative margin. So these two put together is roughly 70% of my AUM. 10% arbitrage, pure arbitrage, and 60% debt. 70% pure, you can say, fixed income kind of returns. Now the interesting part over here is in 2 buckets. First is special situation. So special situation is not something which is totally new. Even mutual fund do it. It includes IPO, open offer, merger, demerger, buyback, delisting. But
some corporate action.
I cannot do these trades in my arbitrage fund. I can do IPO in my balance advantage fund, in my equity saving fund, but not in my arbitrage fund.
Sure.
Here in SIF, I will do all these special situation as a dedicated strategy in my first SIF, which is hybrid long short fund. And the fourth thing is derivative strategy. This is something totally new. Today, not even allowed to mutual fund. It includes straddle, strangle, pair trade, all your covered call trade, everything. Again, mutual fund also can do covered call, but only in Nifty 50 names and only 30% of your holding. So if I have 1 lakh Reliance in my portfolio, in my say balance advantage fund or my large cap fund or any other equity product, if I have 1 lakh Reliance, I can only do covered call of 30,000 shares. Remaining 70,000 always have to be naked long.
Sure.
I cannot hedge them using derivative or any other thing. But in SIF, if I have 1 lakh Reliance, I can do entire 1 lakh covered call. In my mutual fund scheme, if I have 1 lakh BSE, just taking an example, if I have 1 lakh BSE, I cannot do even a one single covered call because BSE is not part of Nifty 50. But in SIF, I can do entire 1 lakh BSE as a covered call strategy. Interesting part is, even if I don't have Reliance and BSE, I can still go and sell call and put option of Reliance and BSE.
Because 25% unhedged.
Naked short is allowed, which I cannot do in mutual fund. So just by doing this simple strategy, I can enhance my return. So total all these derivative strategies, like today in mutual fund, I can buy Reliance, I can sell only Reliance future. In SIF, I will buy Reliance, I will sell ONGC future.
Sure.
Pair trade.
Sure.
Because I feel Reliance is looking good, ONGC is looking expensive.
Sure.
I can buy Reliance short ONGC. So all this kind of trade, I'll be doing it under SIF.
Sure.
So 4 bucket, pure arbitrage, pure debt, special situation and all other derivative strategies.
So how much is this all other derivatives?
Yeah. So pure arbitrage is 10, pure debt is 60 and that remaining 25% is covered call and 15% is all other derivative strategies put together.
So currently,
roughly 40%.
Currently, you all are doing only covered call?
Currently, we are doing only covered call and to some extent special situation also. Okay. So like, I'll just give you...
So if you could explain what is covered call and what is the risk if the price goes above the strike price, please.
Sure. So first, one have to understand what is pure arbitrage trade. Yeah. Pure arbitrage is, I buy Reliance at, say for example, at 1500.
Sure.
And I sell Reliance future at 1510. 10 rupees or you can say roughly 65 basis point is my arbitrage spread. Now, I buy Reliance at 1500, sell future at 1510. Now, only 3 things can happen. Reliance from 1500 can go up,
correct,
can go down or remain where it is. We take all the 3 scenarios so that things becomes very simple. 1500 Reliance becomes 2000. I bought at 1500, it became 2000. How much profit I made? 500 rupees. But at the same time, I sold future at 1510.
You lost 490.
I risked 490 over there. So again, my profit is 10. Take other example, 1500 Reliance becomes 500. I lose 1000 rupees on equity, but I make 1010 on my future short. Sure. Again, my profit is 10. And if 1500 remains 1500,
you still make
I still make my 10 rupees profit. So in pure arbitrage, your profit of 10 rupees will stay with you irrespective what happens to the market.
Correct.
Covered call is slightly different. You buy same Reliance at 1500, but instead of selling future, now you sell call option. Now, again, there are different funds which using different strategies. Some are selling out of the money call option. That means if Reliance is 1500, I will sell 1600 call option or 1700 call option. And then our strategy is slightly different. We are selling in the money call option. Oh. If Reliance is trading at 1500, I will sell 1400 call option at say 130 rupees. Now, effectively, instead of selling future, pure future, I am selling a synthetic future by selling a call option. Now, in normal example, what was the price of future? 1510. Here, what is the price of selling that synthetic future? Strike price
30 rupees
plus premium. So, 1400 was my strike price plus 130 premium. So, effectively, I am selling future at 1530.
Correct.
So, instead of 10 rupees profit, now I am making 30 rupees profit. But this 20 rupees extra profit is not coming risk-free to me.
Correct.
Now, what is the risk? On upside, like in our previous example, Reliance can go to 2000, 3000, 10,000. My profit of 30 rupees will remain intact. Sure. In a flattish market, if Reliance 1500 remain 1500, my profit of 30 rupees will still remain intact.
Correct.
But on the downside, my profit of 30 rupees will remain intact only and only till the strike price which I have sold, which was 1400 in our example. So from 1500 to 1400, even at a 6%, 6.5% fall, my profit of 30 rupees will remain intact. But as soon as Reliance goes further down from 1400, with every 1 rupee fall, I will start losing 1 rupee.
Correct.
So at 1490, my profit will go down to 20. At 1370, at 1390, my profit will go down to 20 rupees. At 1370, I will be at break even. I bought equity at 1500, it became 1370, loss of 130 on equity, and the premium I collected 130 will be the profit. So 130 loss in equity, 130 profit in future, I am at break even. Any fall beyond 1370, I will actually incur loss in this trade.
Yeah.
So that is the risk associated with the covered call strategy.
So how do you decide your strike price? Is it 1 standard deviation, 2 standard deviation?
So normally what we do is, for all the large cap name, we try to sell at least 4 to 5% in the money call option.
Okay.
And then for all the mid caps name, so normally mid cap will be more volatile.
Yeah.
So we try to sell 5 to 7% in the money call option.
Understood.
Now again, depending on stock to stock, like within mid cap also you will have some stable stock, and within large cap also you will have some volatile stock.
Yeah.
Depending on that, we keep on changing our strike price. And the most important thing is we do dynamic delta hedging. That means 1500 Reliance actually goes to 1400. I can sell future, I can buy put option, I can sell more call option to reduce my risk.
So you will continuously keep doing it. It is not that once you've taken the
Yes.
position, you will take the loss if it is
Yes.
not
So
going
we have
in
to
your favor.
dynamically hedge our risk. Even now, even after doing all this thing, a risk of lower circuit or a risk of gap down opening will always be there.
Correct.
If Reliance gradually falls, I can always hedge it. But Reliance today is 1500, tomorrow directly open down 10% lower at 1350. I have to book my losses at 1350.
Correct.
So that risk is always there. And that's why you will see what was the profit I was making? 30 rupees in
30
our
rupees.
example, which is 2% per month, annualized 24%. We are saying we will make only 10% profit. Because I know in some month there will be gap down, not in Reliance, then in ITC, not in ITC, then in Idea. In some other news, some other stock, you will always have that 10%, 15% fall. So we have directly built in a margin of safety in my calculation itself, where I'm saying I will not make 20, 24% return. I'm happy with 10% return.
But instead of doing stocks, suppose if you use the same strategy of 4-5% lower on Nifty, would that not work? I understand that probably your returns are going to be lower.
That would have worked perfectly fine if India VIX would have been at the normal level. Sure. Today, India VIX is trading at 9 to 10, which is one of the historical lowest level what we have seen.
And there are no premiums.
And there are no premium, actually no premium. Once VIX move back to 13, 14, 15, which is a reasonable number, we will do more of index options and index, you can say, saddle strangle and all, so that we make reasonable return over there.
Very interesting. Sorry, I know it got a little complicated, but I got excited to ask him that question because I understand the subject a little, not more.
Yeah.
Is this the solution, or is this what hedge funds do globally? Are we doing very similar stuff?
So if you will see in the hedge fund also, there are different kind of hedge fund. The most popular one are absolute return strategies. So like in India also, in a lot of Cat 3 AIF, we have seen people launching absolute return strategy. So our SIF is more of an you can say ARF kind of product, which is absolute return funds, with much better taxation compared to a Cat 3 long short AIF. So that is the intention with which we are running our product, wherein, as I said, the stated objective is to generate arbitrage plus 3% return with very little drawdown and very few negative quarters.
Will this become a problem if your AUM increases? Because I mean, I'm not sure if today, let's say at 1300 crore that you are sitting at, if this becomes 13,000 crore, will you effectively be able to do what you are telling me right now?
So if you will see, in less than, you can say, 2.5 months of our launch, we have already seen 4x jump in our AUM. We started with 300 crore in NFO, and as we speak, we are at 1350. And the strategy remains as it is, no change at all. Today, if you will see, 70% of my portfolio, 60% was debt, and 10% is arbitrage. So today in industry, we manage arbitrage fund at 17,000 crore AUM, and the largest arbitrage fund is 70,000 crore. So 70% of the portfolio is nothing but arbitrage fund. Or in fact, much better than that, because 60% is in debt. So that 70% portfolio doesn't have any challenge. The real challenge will come at two places. One is all the derivative strategies, and second, all the special situation trades, because see, some of these trades are very limited opportunity trade. Like for example, if we do IPO, we become anchor investor. Allocation is fixed. So we get say 10 crore or 20 crore as anchor. Now a 10 crore position on 1000 crore fund is very good. But same 10 crore on a 10,000 crore fund will not make any, you can say, sense. So that is where we will start compromising somewhere on our returns. But I think the 95% of our portfolio, 70% debt and 25% covered call, today, even without mutual fund not being so active on covered call as per, you can say, the regulation, because in mutual fund there was a lot of restriction. Only last 2-3 months we have started doing it. Even with limited amount of participation for mutual fund, the open interest in single stock call option is 2,50,000 crore. So even if I become 10,000 crore, 25% of that will go into covered call, which is 2,500 crore.
Sure.
Now, 2,500 crore, even with today's open interest, is just 1% of the available opportunity or available open interest in market. And like how arbitrage as a space grew, in 2016-17, we stopped taking money in arbitrage fund because we hit 1,000 crore. And today, when we look at on the hindsight, it was a blunder what we did for a couple of months. Today, there are fund managing 70,000 crore because as more and more arbitrager came into the market, the cost of going long on future went down substantially.
Sure.
And as a result, more and more participants started taking long position. As a result, open interest from 50,000 crore, today is more than 5 lakh crore. Same thing will happen on derivatives also, and same thing will happen on options also. Today, people are buying call option at a premium of 24 to 36% premium. As mutual fund entered, we are happy with 10-12% return.
Yeah.
So if the cost of going long on single stock call option goes down from 24, 30, 36% to say 18, 15, 18%, I'm sure the open interest will multiply from here. And that is where even at a sizable position, we will not find any pain. Some changes have to be made, like we cannot be dependent on IPO or anchor position at that point of time. But I think as size grow, our say in getting higher allocation will also go up. So today, if I look at top 5 AMC, in anchor position, they will get allocation of 50, 100, 150 crore. Whereas, because we follow in 11 to 15th rank, we are into tier 3 or tier 2, our allocation is between 10 to 25 crore. But as we grow in size, automatically, we are sure that our allocation size will also go up. And that should help us to, you can say, in a way, compensate some of those returns. So, but I think today, if you'll see, as I said, we are promising return of around arbitrage plus 3%. Actual returns are arbitrage plus 8%. So we may compromise on that 4-5% return because of the, you can say, much larger size. But I think till the time we are able to deliver arbitrage plus 3% return, people will keep on coming into this product, because more than 3.5 lakh, more than 3,20,000 crore today is sitting in arbitrage and happy at 6% return. So if we are able to deliver 9-10, there is no reason why people will not move.
True. So what I understand, if I can summarize and tell me if I am correct, what you are saying is that 10% arbitrage plus 60% of your debt, 70% of your portfolio is as it is immaterial to the AUM. Out of that, you do 15% in covered call. You may increase that to 25%.
We do 25%,
or you
today, we'll keep it around
25%, right? So that also does not really change, because you are saying there is enough and more open interest available.
Liquidity,
liquidity is not a problem, and that can be absorbed.
Yes.
The remaining 5-10% in special situation is where you might have to
change our
hunt
strategy
for opportunities. So let's say if you might not get an IPO, you might get a demerger story or probably an acquisition story. So that is where you might have to...
And you might get a lot of blocks where promoter want to sell stock at 5, 7, 10% discount. You may directly get that opportunity.
Very interesting. One last question before Bhavesh, I'll let you go out of this interesting conversation, and I'm loving it. But it's extremely important for us to be able to send this message across well of who is this product for. Because you want to be very, very sure when you invest in a product that seems complicated from the outside, right? And unless you don't know if it is not for you, will end up making a mess of your investment. So generally, if you could help us understand, because there are only 2 products available right now. So let's talk about only those 2 products today. Who is this hybrid for? I know you've said that there are 4 different styles within the hybrid also. But if you could answer, who is the right investor category for the hybrid long short? And who is the right investor category for equity long short?
Sure. So I think at least for our strategy, what I can say is all the investors who are looking for a fixed income alternative and are looking at say 8 to 10% kind of post fees, post tax return, our hybrid long short fund is the product for you. For all the equity investors who either were investing in large cap, mid cap, small cap, for them, there will be equity category. So within equity, you have equity long short, which is nothing but your flexi cap and large cap equivalent. And then you have X top 100 long short, which is nothing but your replacement to your mid cap and small cap. So it is very simple. All SIF product, all the 7 categories are in a way is a competitor or an alternative or a substitute to your existing either mutual fund product or some AIF scheme or some PMS scheme.
Yeah.
Now, the interesting part, as I said, is why SIF will fly. Because it have all the benefit of mutual fund, lower ticket size, better taxation, better transparency, daily NAV, monthly portfolio, everything, and flexibility of an SIF or flexibility of an
AIF.
AIF of trading derivative. And similarly, compared to an AIF, you get the entire taxation of mutual fund and you are mini AIF. You don't get leverage, but to offset, you get much better taxation and you get much lower entry ticket. In an AIF, you have to start with 1 crore. You can start with 10 lakhs across 7 SIF put together.
Sure.
So actually, you can start with 1.5, 2 lakh also. So for those set of investors. Now coming to the first product, what we have launched, that is Altiva Hybrid Long Short Fund. I think this is a product where our intention is to deliver arbitrage plus 3% return on a post-twist, post-tax basis. That today is better than all your traditional fixed income product,
Sure.
all your corporate FDs, all your tax-free bonds, and then all your hybrid funds to an extent, like arbitrage fund, equity saving fund, multi-asset arbitrage fund, and also you can say almost touching your balance advantage fund. If we are able to deliver 10-11% return with say standard deviation of 3 to 4, risk adjusted, we are by far much more superior compared to any other product available in the market.
What I hear from you on the return side is point taken. On the risk side, what I understand and hear from you only so far is that if there is a circuit or a 5%, 10% downfall that you're not able to protect on the covered derivative strategy that you've played, that can be one risk. But is there any other risk that somebody should be mindful while they are coming in?
Yep. So another risk is big underperformance in a raging bull market, because we are not an equity product.
Yeah.
If tomorrow equity market goes up 20%, 30%, we will still be delivering you that 10-11% return only. So we are not chasing 25-30% return. At the same time, because we are not chasing 25-30% return, you will not get negative surprise of -5, -10% return also.
But you're saying that even in a bull market, what you are currently doing will still deliver 9, 10, 11?
Yes.
It will not go down.
Yes. And as I said, our benchmark is not Nifty.
Sure.
Our benchmark is arbitrage plus 3% return.
Sure.
Though regulatory, we have a separate benchmark like the category benchmark. But internally, we will, you can say, judge myself. As a fund manager, I will judge myself that how many months I am outperforming arbitrage fund with that 20-25 basis points. So that annualized number is 3%.
Sure. One last question, and sorry. Because you just made a mention that between 2015 and 2025, Nifty's never been in red. The last red that we saw was 2015, and then earlier before that. On the equity side, is the short side of the equity going to be of any use? What I'm trying to ask you is that if I'm a 10-year investor and I'm getting in the equity SIF product, assuming that I will get the advantage of long, but if there are some shorts available, this guy will do a much better job. In India kind of a market, will the equity SIF outperform the long only funds?
Yes, I think, see, for that again, as I said, you have to make sure that you are not having a portfolio which will be permanent short in market. You will always be looking at tactical shorting opportunities. Sure. As I said, even in the best of the bull market, you will have some sectors which are broken, where you will get decent return by going short. So for us, when we launch our, you can say, equity variant of SIF, whether it is X Top 100 or equity long short, our intention will be to have a decent long portfolio with a lot of tactical short.
Sure.
And that tactical short, I will just give you an example. We are not necessarily that we will have directionally short position.
Sure.
Just take an example. We feel Reliance at 1500 is very expensive. In mutual fund, what you will do? Reliance is expensive. Just
reduce
sell it.
The position. Yeah.
Reduce the position, sell it and deploy somewhere else. But Reliance at 1300 is reasonable buy. In mutual fund, what you will do? You will wait for price to come to 1300. Here, every month I will sell 1300 put option. If Reliance doesn't come to 1300, I will make my 1.5% profit by selling options. And in the month where it comes 1300, I will take the delivery.
Correct.
So that is the biggest advantage of an SIF. Not necessarily that I have to go right on my view, either bullish or bearish.
Sure.
Even this tactical shorting opportunities, where again, as I said, the other example, Reliance at 1500 is reasonable. At 1700 is very expensive. I want to sell. I can sell 1700 call option every month. In the month where Reliance touch 1700, I will give my delivery. So I can easily add 3 to 5% return over my existing portfolio without adding risk. My volatility, in fact, will be lower.
Would you, from a risk management perspective, also have a number that you follow that on a particular stock you will not go more
Beyond,
than
yes. So in our hybrid long short fund, we do follow all this risk management practice that any large cap name will not be more than 3% in my portfolio. Any non-nifty name will not be more than 2% of my portfolio. Because see, my strategy is an arbitrage plus plus strategy.
Yeah.
I don't want to take stock specific risk. I don't want to take sector specific risk. So that's why we will keep all this guardrail in place. Because as I said, markets are positive, but one stock like ITC, because of some news on GST or excise duty, stock was down 10%. So you can always lose 10% in a stock even in the bull market. So we don't want to take that stock specific risk. All stocks where there are some corporate actions going on, all stocks where some regulatory, you can say, development is happening, we will try to avoid those stocks in my hybrid long short fund. Because for me, it is an absolute return fund. It is not a directional product.
Bhavesh, it has always been a pleasure talking to you and hear you talk. Every time that I talk to you off, there are 100 new things that I learn. And then I go back and, while it may not look on camera, but now I will go back and read through a lot of things that you said that I even didn't understand. But I'm so glad that you took the time out to be talking to us. And thank you so much for all the explanation that you've done around hybrid and SIF. And I'm sure any and everybody who's watched us till the end would have definitely learned a lot today about specifically both of these categories, which I think that people don't give a lot of importance to, that both these categories deserve.
Sure.
So thank you so much for all the time
Yes.
that you took out.
So again, thanks for having us here and giving us this opportunity. I'm sure we discussed a lot and it was slightly heavy also.
Yeah.
But good that you were able to, you can say, in a way, pinpoint the right questions. And that's why we could have had this, you can say, in-depth discussion. I'm more than happy to have another round of discussion
100%.
as and when you feel that things have become more popular, and then definitely will be there. So
100%.
thanks once again from us.
Such a pleasure.
Thank
Thank you so much.
Thank you.